Hello and welcome to Startup Street. I'm Arundhati Ramnin, and with me as always, Shruti Mishra. These are the top headlines from the startup world. Central Consumer Protection Watchdog issues notices to Ola and Uber after receiving almost 19,000 complaints against the platforms. The cab aggregators have also been pulled up for the lack of adequate grievance redressal. Notices also to cover concerns of unreasonable levy of cancellation charge and lack of info on algorithm.
Amazon lays off about 100 employees in its video game division as part of its broader cutbacks affecting workers at Prime Gaming, Game Growth and the company's San Diego studio. Our resources will be aligned to support our focus on content, says Games Vice President Christoph Hartmann. He wrote in a memo to employees seen by Bloomberg.
Nazara subsidiary Nodwin Gaming to acquire 51% stake in Singapore-based live events firm branded as The Company looks to boost its international presence. The deal is being done by Nodwin Gaming's Singapore subsidiary through a combination of primary capital infusion and secondary stock purchases from the existing shareholders of branded. Stock market filings reveal.
Electric mobility solutions provider Magenta closes a Series A1 funding round with $22 million equity investment from the UK-headquartered BP and Morgan Stanley India Infrastructure Managed Investment Fund. The company plans to deploy the freshly raised capital in fleet and geographical expansion.
Health tech startup Dozy raises $6 million as part of its Series A2 funding round from existing investors Prime Venture Partners, 314 Capital and Yawnest VC. Dozy will use the new funds to expand operations globally.
The centre has sanctioned more than 40,700 crore rupees to 1,80,000 beneficiaries under the Stand Up India scheme in the last 7 years. The beneficiaries include 1.4 lakh women entrepreneurs, while 26,889 belong to the scheduled caste and 8,960 to the scheduled tribes.
Cryptocurrency Dogecoin rallies 30% after Elon Musk replaces the iconic bluebird logo of Twitter to the dog meme for the web version. Meanwhile, Musk faces more legal troubles after a lawsuit claims contract workers were laid off illegally without notice.
Those are the headlines we are tracking for you this evening. Speciale Invest, a venture capital firm focused on early-stage investments in deep science and enterprise technologies, has announced the launch of its Speciale Invest Growth Fund 1. The new fund has an initial investment of 100 crore rupees and has received approval from SEBI to provide Series A and above funding to high-potential technology startups supporting India's enterprise and deep tech startup ecosystem. To talk to us about Speciale Invest Growth Fund 1, joining me now is Managing Partner Vishesh Rajaram. Also joining me is my colleague Arundhati. Vishesh, welcome to Startup Street. Now, Speciale's investment philosophy is centered around providing capital to startups within the potential to disrupt and transform their industries. What areas within emerging technology are you going to focus on, and how many startups are you looking to fund this year?
Hey, hi, thanks for having me here today. So if you step back, we've been actively investing for the last 5 to 6 years. The sectors that we've historically focused on include space tech, industry tech, robotics, quantum security, semiconductors, and most recently, energy transition. I think going forward, we continue to see a lot of opportunities in semiconductors, in climate transition, climate tech, and we're also focusing more on the biosciences side. So we're hoping to do between 3 and 5 deals over the next 2 years, each year, so about 8 to 10 deals between 2023 and 2024.
All right. Vishesh, the new fund has an initial investment of 100 crore rupees. Where do you hope to close the fund finally? And as a deep tech investor, what is your take on AI? While there are apprehensions it is taking the world by storm, your bets on this space?
So the fund size itself, we expect to possibly in about 2 quarters from now end at about 200 crores. That's sort of the limit we've set for ourselves, as we expect to use this fund to largely double down on existing portfolio companies and participate in their growth journey. Coming to the other question, particularly on AI itself, I mean, a lot of it is uncovering as we speak. There's GPT-4 and 5 that we're talking about. I think it'll be interesting to see applications that you can build on top of these large platforms or large technologies. And I think the opportunity that we're seeing internally is also around where you could use these to create a quantum impact in how technology is consumed.
All right. Vishesh, hi, Arundhati here. You hope to make follow-on investments in winners from your early stage portfolio companies. So take us through which ones you're betting big on. How well are your portfolio companies faring at this point?
So of course, it's early days. We're doing deep science in tech. It takes between 5 and 7 years to see really strong results out. But I think we've been a bit fortunate across the Fund 1 portfolio. We've got a few investments in space, Agnikul, Cosmos, Galaxy being the other. Both of them sort of raised follow-on rounds of capital, continue to progress well on the technology roadmap. We've got E-Plane company. They've got a prototype that they should be flying soon. And we've also got Singular Robotics, which about a month ago put out one of India's largest robotics R&D center.
Right.
So we will see some of our investments go to some of these companies from Fund 1 as we play out. And we've got an exciting set of software companies and hardware companies in our second fund. Nutrace one being in the hydrogen space. We've got Cuno Labs, which is in the quantum security space, and most recently another investment which makes lithium batteries for the country.
All right.
So some of these I'm sure will raise growth capital as we progress along, and we're keen to be part of their journey as they scale up.
All right. Since you mentioned your first fund and your second fund, in 2018, you raised your first fund, which backed about 18 companies. And we've seen about 5 early exits. And you plan to invest in 20 to 22 companies via your second fund. So where are you on that front in terms of investments? And what's your exit strategy?
So Fund 2 is still in its early days. I think we've invested in about 10 companies, call for about less than 30% of the capital. So 2023 and 2024 is going to be all about going in and working on more companies and trying to pick good technologies that we want to back in. So we expect to invest in 10 to 12 companies between 2023 and 2024. So that takes the overall portfolio size to about 2022.
Okay. Amid a funding winter where we have mostly seen early stage funds come up, you will be investing in Series A and growth stage companies. Are the valuations looking attractive to you? Have you seen a recalibration in valuations right now?
So I think, I've been in the business now for the last 16 years. If you're long enough, you're going to see these cycles every 5 to 7 years. What's constant is that these cycles will come and go. You will find winters, you'll find summers. So given that we're investing over a 3 to 5 year period, we largely insulate ourselves to some of these short-term trends that shape up. But I think coming to your specific question, the deep science and tech play, at least that part of our portfolio, has not seen much of a multiple compression because that entire vertical or that entire segment is still very early and evolving. So it's still early to call verdict on whether there's a multiple compression of it because there aren't global comparables to this, right? Some of these companies are truly building out of India for global markets. And hence, it's not easy to say that, oh, the listed market equivalent of this is down 20% or 40%, and hence you need to mark these down. I don't think a lot of our portfolio fall under that category, and hence we're still sort of tracking, building product, going to market, and getting product market fit.
All right, we're also excited about the enterprise SaaS startups, and India is emerging as a leader in this space. So how big is this opportunity, especially when it comes to building in India for the world?
So I think, there are a lot of good reports that have been put out, SaaS Boomi, McKinsey, and all of them have pretty much put this to be $1 trillion plus in sizing. And there are different ways to slice and dice it. They talk about vertical SaaS, they talk about horizontal SaaS, and dev tools that are getting built out. I think the opportunity is pretty big. It's important to make sure you do this in a capital efficient way so that you're able to be globally competitive.
All right. One final question, Vishesh, before I let you go, what excites you about a pitch for all our viewers here and for all the startups? I want to know what's the selection criteria? What is it that excites you about a company?
Yeah, more often we're trying to build on somebody else's vision. So the vision needs to be large. We need to work with founders who know things that most people don't know. So, the moat or the knowledge of the domain that they carry, which is truly unique, which possibly allows them to go build a business that carries a tech moat. I think that sort of sums what we look for in companies. Strong founder moat that leads to strong tech moats.
All right, Vishesh, thank you so much for joining us on the show, and we wish you all the best going forward.
Thank you very much, guys. Have a good evening.
Investor Iron Pillar has successfully closed $129 million for the first ever growth stage fund, which is focused on investing in global cloud software companies which are from India. Now, Iron Pillar currently has nearly $500 million in assets under management, and this particular fund is part of Iron Pillar's Fund 2 series of funds. Joining me now to talk about this is Anand Prasanna, who is the managing partner at Iron Pillar. Anand, welcome to Startup Street and thank you very much for your time. If you could start by telling us where exactly you plan to deploy this latest $129 million that you've closed. I know you look at software companies primarily, but have you identified specific companies, and by when will this be fully deployed?
Thank you for having me at Startup Street. For this fund, we have actually already every year been tracking around 40 companies. So we have around 120 companies pipeline, and currently tracking that. Potentially we'll invest that in the next couple of years.
All right, so how soon will you be deploying it? I mean, you have 120 companies, surely you won't be putting money in all.
Yeah, no, we typically invest into 8 to 12 companies in a fund, and it'll take 2 years, sometimes even 2.5 years for us to invest.
All right, but how soon will you start writing these checks, given that you have companies identified, and what is the typical check size like for each investment that you make?
We have actually started writing a couple of checks already from this fund, and typical check sizes which we write are anything from 8 to 12 million initially, and we could go up to $20 million in a company.
Focus, like we've been talking about for Iron Pillar, has been SaaS and consumer tech very much. Why just those two? I mean, is there a reason behind that? And any specific themes within these two that look more promising to you from an investment point of view?
So this particular vehicle is fully focused on SaaS for global markets. Inside that, we invest into 4 areas: automation, security, dev tools, and also future of work and education. And in consumer tech, we typically like full stack businesses in consumer tech in areas like food, education, and even sometimes like B2B, B2C brands.
If you could tell us how the outlook is looking in this environment, are there any other exits which are lined up, or is it getting harder to do that?
Interestingly, and I'd like to thank our founders, we have some very good assets, and there is some good interest from other buyers to potentially acquire some of these assets at this point of time. There is also some IPOs which are getting lined up for the IPO market to open up and get exits there. So we expect significant amount of capital to be returned in the next 12 months itself from these avenues.
We know your portfolio companies. Any names you could share with us? Which are the ones where you're eyeing an exit? And what kind of returns on those investments?
Specifically, I wouldn't want to name companies because these things keep on changing in terms of opportunities. But in terms of returns, we can say that our vehicles are anything from 38% to 80% IRR. And in terms of multiples, they are anything from 3.1 to 4x. So we are hoping to kind of, in our first fund, for example, return full amount of their money by next year, which would be the 5th year of the fund.
The risk appetite of investors has certainly gone down. A lot of them are also looking inward at companies closer to home. In this environment, what has Iron Pillar's approach been, and how do you ensure that your investments are protected in this environment?
Look, there's 2 sides to this coin, right? SaaS built from India for the world have grown 5x in the last 5 years, and is a 12 billion revenue market from India. Now this, and I'm talking about Bain & Company's numbers here, not ours, they are expecting this 12 billion to go to 35 billion in the next 5 years, and that's a fundamental shift. Now, if a lot of global people are not investing, we being the first growth stage fund for this opportunity should find better opportunities to invest in at better valuations. That's one. Number 2, one of the key pillars of Iron Pillar's value add is ability to bring global investors alongside us. So capital as a serious area of value add for our portfolio companies is something we bring along. So we're not that worried about that piece.
Largely, with your portfolio of companies, you're happy with their performance, no tough decisions, having to be made there?
Tough decisions are always there, depending on what kind of tough decisions you make, right? But the fact is that you always take tough decisions in good or bad.
Given that we are seeing a lot of, given what we're seeing happening, with startups across the spectrum, whether it is restructuring, it's layoffs. Of course, some are impacted more than the others. But how has generally your portfolio performed?
Generally, the portfolio performed very, very well. In fact, it's proven by the fact that most of our portfolio companies have raised up rounds in the last 1 year. That being said, there are definitely startups. Every company have an opportunity to improve their operating metrics, cut the fat, etc. And the founders always make use of opportunities like this, what currently is there in the market, to create better operating environment, better operating synergies inside the businesses, and actually also take slices whenever it is needed.
All right, Anand, thank you very much for your time here and for sharing those thoughts. It's been a pleasure speaking with you. Thank you.
On that note, it is time for us to head into a short break. Coming up next in our special series, A Unicorn Health Check, we delve deep into the insurtech space and take a look at how those companies are faring.
Welcome back to Startup Street. PhonePe founder and CEO Sameer Nigam says the company will explore a potential listing through an IPO in 2024-2025, provided the market condition is conducive. Speaking exclusively to Shireen Bhan, he also said interchange fee on UPI is inevitable in the future and also found the whole idea of layoffs by global companies obnoxious. Take a look.
The wallet play doesn't involve an interchange because the issuer ties up with a shopkeeper and they pay them directly. Again, my gut says this will get normalized or standardized pretty soon across the industry. You'll land at about somewhere between 1.4 to 1.6%. I think it's inevitable, but my reasons for saying that are slightly different. I think there's a considerable amount of investment that's happening outside of the banking system. This is the fintech system, as we call it, both on the consumer side and the acquiring side. So at this point, I'd say 24, second half, 25, we'll start looking at the right time for an IPO. Obviously, the market environment also has to change a bit. I don't think it's a good time for tech business to go public. Comment on Paytm specifically, but I'll say this. One, I think a lot of these well-known brands, Paytm, Zomato, Nykaa, and others, I think they ended up going public in India when the VC market was at its absolute peak worldwide. And I'll give the shout out to a Paytm. I think the business looks fundamentally more healthy today than it did 4 quarters ago when we look at it from a distance. So maybe the markets help the players grow up fast fiscally as well. It's a good thing. I do think, however, it's very different than the large big tech platforms in the US doing massive layoffs worldwide. In part, honestly, as an entrepreneur, I find it a little obnoxious because these are very large, very profitable companies with very large ambitions. They're investing in the ambitions, but they're laying off the people. So I personally don't subscribe to it. I'm glad that the Indian founders are not following suit that way. I think as a market overall, also, I think we're a little more empathetic. I'm not for protectionism at all, but I also don't like sort of this perversion between record profits and record layoffs. I don't understand that one. I don't think India will do that.
In our special series, The Unicorn Health Check, we're going to look at India's startups in the insurtech space. Now, the insurtech segment got a significant boost during COVID and is only maturing as more categories of the industry are starting to attract funding and leverage technology. India appears to be valued higher by investors due to higher operating leverage and the perception of greater proximity to customers. Globally, funding to insurtech has grown at a CAGR of 37% during FY17 to FY21, while funding to Indian insurtech companies has grown at a CAGR of 34% during the period. Now, the total insurance market in India is projected to grow from 8 lakh crore rupees to about 33 lakh crore rupees by FY31 at a CAGR of 14.9%, aided by increasing penetration levels and government initiatives. Let's start with Policy Bazaar, which is an app-based comparison platform for life and non-life insurances. The firm, which is backed by the likes of Temasek, Tencent and SoftBank, is valued at $2.4 billion. Now, Policy Bazaar's parent firm, PB Fintech, saw its losses narrow to 87 crore rupees in the third quarter of this financial year versus 298 crore rupees for the same period last year. Revenue from operations surged 66% on a year-on-year basis to 610 crore rupees. The firm's credit business hit break-even in the December quarter ahead of expectations. Now, the insurance premium business saw 70% year-on-year growth to over 3,000 crore rupees, while the credit disbursal business saw growth of 57%. Now, PB Fintech's expenses increased to 766 crore rupees. The company said that it expects to become EBITDA positive by the fourth quarter of this financial year and is confident of delivering the first full year of profits in 23 to 2024. Now, let's go to the next one, which is Digit Insurance, which is essentially a platform for auto, health, travel and flight delay insurance and is valued at $4 billion. The firm reported total revenues or premium of over 5,200 crore rupees for FY22. However, net losses widened to 295 crore rupees in FY22 as against 122 crore rupees in FY21. Now, the firm sold 7.76 million policies in FY22. This was driven by higher demand from motor, property and health segments. Go Digit Insurance also refiled draft papers for a $440 million initial public offering after addressing the market regulators' concerns related to the company's employee stock plans, which had initially stalled the offering for months. Finally, digital insurance firm ACO has raised a total funding of over close to $460 million. ACO's revenues soared 2.37 times to come in at over 1,300 crore rupees. Income from the collection of the gross premium contributed 61.5% of the total revenue, which surged 2.3x to 826 crore rupees in FY22. However, the General Atlantic-backed startup saw its net loss increase 3 times to 483 crore rupees versus 132 crore rupees in the previous fiscal. ACO spent 1.37 rupees to earn a single unit of operating revenue. However, the improvement in unit economics augurs well for the firm. Aggressive marketing aside, feedback on claims handling has also been positive. And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.